Hello, everyone, and welcome back to HardMoneyJim, where we discuss themes related to money creation and its consequences. Today's June 29th, 2025, and I'm speaking from summer quarters here in beautiful Jackson Hole. Starting tomorrow, I'm planning to take a midsummer break for a few weeks, so it might be a while before I return, but if there are any significant financial developments during that time, I'll try to comment as soon as I can. Before we dive into today's main topic, which is stablecoins, I'd like to make a brief statement about my goal for these videos and essays and podcasts. Now, in my view, the financial media is packed with advocates who say what they think their audiences want to hear, using language that reinforces their readers' prior existing biases. For example, some pundits will criticize policymakers for wielding too much power or for violating rights, your rights. For example, immigration is costing you money, or tariffs are immoral, or taxes are excessive, or inflation is stealing from you. Now, these claims may contain a shred of truth, but they often sound the alarm on issues that are already baked into the market, or they exaggerate the negative effects of these issues. Now, I have no interest in this kind of rhetoric. Personally, I'm a strong advocate of limited governments and free market, but in my role as HardMoneyJim, I'm an analyst and not an advocate. And I want to understand the financial waters that we're navigating, figure out how to direct my savings to preserve and grow my family's wealth, and having learned that, pass that information to you. So in that vein, I'd like to share a passage from a Substack author called Doomberg, who is the best energy analyst I know and highly recommended. Doomberg recently wrote the following: "How can you tell the difference between an analyst and an advocate? It is all in the handling of the data that runs counter to assertion. To an analyst, being wrong is disappointing, but it is primarily an opportunity to learn, an expected element in a feedback loop of continuous improvement. When knowledge is your only objective, there's no such thing as a bad fact, only one you do not yet understand. Not so for the advocate. The advocate has tied their hopes, and often their livelihoods, to a specific outcome and feels compelled, whether consciously or not, to rationalize away or attack inconvenient realities. It is advocacy when every perturbation in the weather is tagged as climate change. Each squiggle of unfavorable price action is declared market manipulation, and no act or utterance from a favored or disfavored politician is considered disqualifying." Now, I would love to see that quote posted on the office door of everybody who claims to be an analyst. Objectivity is hard, but it's not impossible. That is what we are striving for here. Now, objective analysis requires a framework, a plan, a format to follow when you're dissecting a problem. I have such a framework for analyzing sovereign debt problems, which I spelled out in chapters 6 and 7 of my book, A Black Hole in Economics. And let's briefly review that now. To understand how the government influences money creation and what happens when it spends new money, we need to focus on the incentives and constraints of the government actors who implement policy. An advocate might criticize the hypocrisy of politicians or the contrast between their words and their actions, but an analyst should focus on their actions rather than their stated intentions. So, for example, if they say they want to reduce the deficit, we have to ask, do the policies and laws they implement actually accomplish that? We should assume that what they accomplish is what they actually intended to do. As Winston Churchill said, behavior does not lie. Now, politicians operate within the realm of pragmatism, even though they often cite high-minded principles in order to win favor with their constituents. But in politics, pragmatism prevails. The contrast between their principles and their pragmatism causes them to say some strange and sometimes contradictory things. For example, In December 2008, George Bush said the following on CNN to try to justify his support of the massive bank bailouts. Remember the TARP program? He said, quote, "I've abandoned free market principles to save the free market system." Now that's a classic. From those words, you'd think he was in favor of free markets. But we ended up with a regulated bank system about as far removed from free markets as one could imagine. So he professed free markets, but his actions said otherwise. In other words, his behavior did not lie. Now, because our politicians' main goal is to stay in office and retain political power, they must appeal to voters by appearing to keep their promises, especially promises to pay financial benefits known as entitlements. Politicians can hold on to power only by winning one election at a time, and therefore the focus of politicians in a democracy is on winning the next election, which is always just a few years or a few months away. So politicians have very little incentive to pursue long-term solutions to our difficult debt problems, even though they may have genuine personal concerns for the nation's long-term financial health. Now, the primary motivation is finding enough money to keep the political system running until the next election. This leads them to focus on short-term cash flow rather than long-term financial planning. So that's the first key aspect of our framework. Politicians prioritize short-term, year-to-year cash flow when managing government finances. They're compelled to keep their promises one election cycle at a time. This is their world, the one they live in. They have little motivation to think beyond it. And so far, they have been able to fund the government year by year. The long-term solution, they hope, is going to emerge on somebody else's watch, after they're out of the game. Right. Now, the second equally important fact driving our framework is that you, the productive member of the economy, you're probably a saver, are the only real source of wealth that politicians can tap into. If you receive more wealth from the government than what you pay in, the government is your financial benefactor. Conversely, though, if you pay in more than you will get back, the government is your financial adversary. Now, obviously, if our aim is to build and retain wealth, we need to earn and accumulate more than we pay into the government because we want to be wealthier than what we would be by merely collecting government benefits. Therefore, if you choose to become wealthy, government is your financial opponent, your antagonist. Government needs to take your wealth to keep its promises to others. So it's your job, my job, to anticipate their actions and take steps to limit the impact of their tax and inflation policies. This necessity to view the government as our financial foe is why I adopted this slogan from Sun Tzu's Art of War. Quote, "To know your enemy, become your enemy," which simply means think like your enemy. Become your enemy means to become the politician, become the regulator, become the bureaucrat. Ask yourself what you would do if you were forced to act in the same situation the government faces. Thinking like they do will help you anticipate their eventual moves. So this is the approach I took when writing Chapter 7 of Black Hole, where I essentially brainstormed potential policies that our politicians and regulators might adopt in their quest to seize your cash. The government has 4 financial levers it can pull to keep the financial machine running. The first 2 levers are designed to maximize cash inflow to the Treasury, and these 2 sources of cash are, first, increasing revenues through taxes, fees, tariffs, and so forth, and second, maintaining or increasing the ability to borrow. The next 2 financial levers are designed to minimize cash outflow from the Treasury. Number 3, suppressing interest rates in order to minimize interest costs. And 4, delaying or reducing promised payments without really admitting that that's what you're doing. So every move they make within these 4 categories will have economic effects on you and your wealth. Okay, that's my simple framework for analyzing the actions governments can take to manage their unpayable debt. And today we're going to focus once again on financial lever number 2, increasing the government's ability to borrow, just as we did in the last video that I did dated June 10th, which was titled, What Do Governments Do When the Treasury Well Runs Dry? Now, as we'll soon see, stablecoins are going to become a major new source of borrowed money for the U.S. Treasury. Before we get into stablecoins, let's update that June 10th video that I did. You might recall that we discussed a pending change in bank regulation, which will encourage commercial banks to purchase more short-term Treasury obligations. This change will involve lowering the special leverage ratio, the SLR, which currently limits how many Treasury bonds a commercial bank can buy without requiring equity shareholders to provide additional capital. To simplify the problem, under current banking regulations, large banks are required to hold 3% of their assets as free and clear collateral against their Treasury bond holdings. And therefore, if a big bank's balance sheet is fully invested, it can't buy any additional Treasury bonds because that would push its SLR below the required minimum. Now, if you need details on this, please refer back to that June 10th video, which can easily be found on my Substack channel. The important thing to know about this is that the forthcoming changes to the SLR are going to relax this rule, encouraging banks to buy more treasuries. From a money creation standpoint, this policy will encourage banks to monetize a lot of government debt, meaning they will create a significant amount of new money when they're buying these treasuries. As an update, I want to show you a couple of graphs that illustrate the potential implications of what can happen when banks become monetizers of U.S. government debt. The first one here is from Lynn Alden's website. Now, incidentally, I highly recommend Lynn Alden's investment service, as her work is very informative and accurate, and it's not expensive. Now, she and I arrive often at very similar conclusions on many issues because we both share the same understanding of how money is created. However, we are not affiliated in any way. Now, this graph shows that after World War II in the late 1940s and early 1950s, Treasury securities comprised a very significant portion of U.S. commercial banks' assets, even accounting for a majority of their assets for a brief period there. This was an example of how the government can use the banks to convert Treasury bonds into money as a way to inflate away war debts. Now, that was relatively easy to do at the time because our World War II debts were a one-time issue. Unlike today, there were no open-ended obligations that would recur year after year, regardless of how much debt we have now or how much we pay down. So back then, the inflation problem was a one-and-done type of event, one big surge that disappeared as Treasury bondholders were paid off with debased dollars, and the real economy grew rapidly during the post-war recovery. The next graph is one I created using Federal Reserve data. The idea here is to demonstrate how bank purchases of treasuries are already contributing to the creation of money. The red line represents the annual growth rate of the broad money supply, M2, and you can see that it was very high in early 2022. That's on the left side of the graph, well above 10% annualized. This high growth was due to the COVID monetary stimulus program, which involved both large-scale quantitative easing and numerous new bank loan guarantees by the Treasury, both of which added money to the money supply. As the dip below zero in 2023 indicates, the money supply actually contracted slightly before beginning to grow again in early 2024. Now, currently, the total money supply is growing at a rate of just under 5% per year, and you can see this from the red line on the right side of the graph. Okay, next, the blue line shows the rate at which banks are increasing their Treasury bond holdings. And this measures the growth of the money supply driven by Treasury purchases, because each Treasury bought by the bank creates a new bank deposit dollar for dollar. That's money. On the top left of the graph, look at the blue line. You can see that the annual growth rate of Treasury purchases surpassed 20% in early 2022. Now, notably, that spike was due to the Fed's temporary reduction of the special liquidity ratio, the SLR. So you can see the effect it has. Banks took advantage of this relaxed rule by loading up on T-bills, which they bought from private investors in the open market. For a short time, banks were able to buy as many T-bills as they wanted with no limit. And for every dollar of T-bills they purchased, they created a new deposit in the bank account of the seller of that T-bill. When the SLR suspension ended, the growth rate then slowed significantly as those T-bills matured and left the bank balance sheets, ran off the bank balance sheets, eventually turning the growth rate of T-bill ownership negative, as shown in the middle of this series. However, notice that since mid-2024, the growth of Treasury holdings in the banks has turned positive again. And it's now accelerating, indicated by the blue line crossing above the overall money supply growth. That's the blue line rising above the red line. You can see that on the right side of the graph. Now, as the new, looser SLR rules come into effect, you can expect the growth rate of banks' Treasury holdings to rise very sharply. Okay, finally, look at the dashed green line, which shows the growth rate of all types of loans listed on the U.S. banks' balance sheets. Now, we usually think of private bank loans as the main driver of money supply growth. That's how our system was actually designed to operate. But notice that during the COVID stimulus period, loans grew rapidly, exceeding 10% per annum, thanks to the government loan guarantee programs. Loan growth then declined as the COVID programs ended, and loan formation then slowed to nearly zero, but lately it's recovered to its current growth rate of less than 5%, which is pretty low compared to historical standards for loan growth. Okay, so the main purpose of this chart, busy as it is to illustrate that the growth of Treasury holdings is already disproportionately contributing to the money supply. That is, it's expanding at a rate faster than the increase in the money supply from lending. I want to stress to you that banks buying T-bills is not productive money creation, because the new money generated by a Treasury bond purchase initially goes to the selling investor, who will likely then just bid up the prices of new investments in stocks and bonds, which is what happened during QE. Now, as I outlined in Chapter 4 of Black Hole, only new money created through productive lending has a real chance of being non-inflationary, because it's more likely to be invested in developing new products and services instead of bidding up asset prices or being spent on, pure consumption. As of the end of last week, the SLR train is moving forward, and the rule change is almost a done deal. Just this last week, the Fed voted to adopt these new relaxed rules, and now the review is being forwarded to other regulatory agencies who will probably sign off on it soon. That's according to a recent Bloomberg article. And now, just to reiterate a point from our last video, banks' purchases of government securities are unambiguously inflationary, because this is unproductive money creation. Like QE, this policy is likely to have a positive boosting effect on stock prices, gold prices, and possibly Bitcoin prices. That is the latest update on the special leverage ratio. Let's now move on to today's main topic, stablecoins, as another new source of funding for our money-hungry Treasury. Now, we're still talking about financial lever number 2 in our framework. That is, we are talking about the U.S. Treasury attempting to find yet another source of new lenders, that is, new buyers of Treasury bills. What are stablecoins? Stablecoins are digital tokens that can be exchanged for fiat currency, with each token representing a fixed amount of that currency. The two largest stablecoin issuers are Tether and USDC, and their asset growth in recent years is shown here. Each coin, so-called coin or token, is denominated as worth $1 per token. And on the left-hand graph, Tether's assets are depicted by the blue line, while USDC's are shown by the red line. Together, these two stablecoin issuers currently account for over $250 billion in value. Now, as the right-hand chart illustrates, these stablecoins are being increasingly used for international fund transfers. In just one quarter, that happens to be the peak quarter of 2024 that you can see there, Tether moved over $300 billion cross-border, while USDC transferred about $100 billion. So how do stablecoins work? Pretty simple, really. First, you open an account with a provider like Tether or USDC. Then you send them dollars to buy stablecoin tokens, one token for each dollar you send. And the company then invests your dollars into short-term Treasury bills that are an interest. And this interest typically goes to the issuer, not to the stablecoin holders. So, Tether and USDC pocket the interest. For example, Tether earned $13 billion in profit in 2024, mainly from Treasury bill yields, but the holders received none of this. Now, in my opinion, this feature will need to change in order for these instruments to become truly popular, because these things compete with money market funds that currently pay interest at a rate of over 4%. But anyway, each token you buy is valued at $1. To pay another party with these things, that party also has to have a stablecoin account. So you just transfer tokens to their account, from your account to make a payment. As money flows into or out of the stablecoin network, the company just issues or retires tokens so that each token you own is always exchangeable for $1 in conventional money. By conventional money, I mean bank deposits. Now, other than the fact that these tokens don't, at least at this time, pay interest to holders, they do operate similar to money market funds. Since T-bills are bought and sold in a highly liquid market, they can be easily converted into dollar-denominated bank deposits. Therefore, the tokens can trade between parties just similar to bank deposits, as long as the users trust their safety and convertibility. Stablecoins facilitate payments and transfers more easily than other forms of payment because settlement occurs within seconds. Now, by settlement, I mean this. When any financial trade is settled, it just means there's no longer any payables or receivables outstanding. That is, the trade is a done deal. The cash is in your account. Traditional bank transfers or liquidating a money market fund might take hours or even days. And additionally, stablecoins have much lower transaction fees compared to credit cards or wire transfers. The Biden administration largely ignored stablecoins. Instead, they delegated policy to SEC Chairman Gary Gensler, who frequently threatened to impose draconian policies, and that cast uncertainty over this whole market for years. However, the Trump administration has embraced this newfangled monetary gadget, making the administration's efforts to regulate stablecoins more significant. On June 17th, the Senate approved the so-called Genius Act, which stands for the Guiding and Establishing National Innovation for U.S. Stablecoins. The Genius Act is the first legislative framework for regulating stablecoins in the United States. It was passed by the Senate with strong bipartisan support, 68-30. And its stated aim is to regulate payments with stablecoins, improve customer protections, and preserve U.S. dollar dominance while encouraging innovation. Now, that's the official reasoning anyway. The government claims these crypto coins are a major innovation and benefit for consumers, and private businesses and token service providers. That might be true, but realistically, we should ask why the federal government wants to get involved, especially to the point of accelerating the adoption of stablecoins and regulating them in a way that requires them to be backed by U.S. government T-bills. For every dollar of stablecoins, issuers must hold at least $1 of reserves in short-term treasuries or bank-insured deposits or government money market funds, or repurchase agreements backed by T-bills or some other liquid federal government-issued asset that's approved by the regulator. This means stablecoin funds cannot invest in risky, high-yielding assets. The key point is that the foundation of these stablecoins is and will continue to be T-bills, treasury, short-term treasury obligations. In short, like the relaxation of the special leverage ratio, stablecoins may open up a large new source of borrowing for Uncle Sam. Now, how big is this new market? On June 10th, when testifying before Congress, Treasury Secretary Scott Bessent estimated the additional market for treasuries unlocked by stablecoins could reach $2 trillion. Then, on June 7th, the day the bill was approved in the Senate, he increased the estimate to $3.7 trillion. In this tweet shown on the right, he says, quote, "A thriving stablecoin ecosystem will drive demand for U.S. treasuries, which back stablecoins, helping to lower interest costs and control the national debt." Then he positions stablecoins as a win-win-win for business, treasury, and consumers. You know, the fruits of smart pro-innovation legislation, quote. However, I think it's clear that the government's primary motivation is to access a new and larger market for U.S. Treasury debt, thereby alleviating some of the pressure on the government to find new lenders. That fits our framework for analyzing sovereign debt. Congress and the Treasury support stablecoins because they need more money. End of story. Stablecoins are promoted as a major innovation and future of finance, but why should the private sector want them so badly? It's not as if we don't already have, efficient digital payment systems. That's essentially what modern money creation is, an entry on a digital ledger at a bank. Approximately 90% of all U.S. domestic payments are processed through the banking system, meaning digital entries are debited from the buyer's bank account and credited to the seller's account. Now, these ledger entries are transferred through a complicated network of banks and payment processors like Visa and MasterCard. And this interconnected network handles billions of transactions daily. It's a competitive industry that continually advances and improves. And the reality is that the current system works pretty well. So inquiring minds might wonder, why do consumers need a new payment system that tries to bypass the banks? Well, my initial reaction was, well, we already have this efficient industry of money market funds worth around $6.7 trillion, mostly composed of T-bills. If this new stablecoin product competes successfully with both money market funds and interbank payment systems, wouldn't it simply be cannibalizing T-bills as investors switch from money market funds to stablecoins? But that would just be a shift in demand for T-bills, not an increase in demand. So how does this benefit the government? Well, Scott Bessent provided the answer in an interview with Miranda Devine of Podcast One, where he very openly explained why stablecoins are so important to the U.S. Treasury.
Because crypto, that seems to be a threat to the dollar, doesn't it?
I think it's the opposite.
Oh, really?
I think stablecoins could reinforce dollar supremacy, because stablecoins could end up being one of the largest buyers of U.S. Treasuries or T-bills.
Mm-hmm.
So all of a sudden, if you are using a stablecoin in Nigeria that's backed by the U.S. dollar, you don't actually have to have dollars. It's on your phone. You can transact. So I think there's a very good chance that crypto is actually one of the things that locks in dollar supremacy.
And is that why it was crucial that Donald Trump get involved in crypto rather than trying to constrain it like Joe Biden was.
I think constraints too mild a word. I think make it extinct.
Oh,
So this administration's commitment to digital assets, it's innovation because there's so many other things that happen around digital assets. And also, it's one of those things that it's one of the most important phenomena that's happening in the world. And the U.S. just ignored it. And what we are doing, the very good bill that may get voted on in the Senate next week after, that will bring crypto and digital assets and make the U.S. the leader.
Miranda Devine says, because crypto, that seems to be a threat to the dollar, doesn't it? Besant says, I think it's the opposite. I think stablecoins could reinforce dollar supremacy because with stablecoins could end up being one of the largest buyers of U.S. treasuries or T-bills. So all of a sudden, if you're using a stablecoin in Nigeria that's backed by the U.S. dollar, you don't actually have to have dollars. It's on your phone. You can transact. So I think there's a very good chance that crypto is actually one of the things that locks in dollar supremacy. Besant then, after that interview, or at the end of that interview, highlighted the supposed benefits for all other stablecoin participants, even framing it patriotically by stating that the USA should lead in this new and innovative technology. However, remember that Besant is the chief bond salesman for the U.S. government. It's clear that his main interest is in creating a larger market that'll enable him to sell more bonds. Stablecoins bypass the banking system, and therein lies the main source of the new demand for T-bills, because billions of people worldwide do not have access to a trustworthy bank. However, almost everyone does have a mobile phone with internet access. Now, this means I can send a stablecoin token to anyone in, say, Ukraine or Uganda, provided they have a phone and a stablecoin account. So I just instruct USDC or Tether to transfer a specific number of my stablecoins, each worth exactly $1, to someone else's account. Security against fraud is partly handled by the blockchain system and partly by the U.S. government's oversight. This is a fast and private system, although I do think the government is likely going to want some visibility into individual accounts in order to deter criminal activity. Another example, imagine you're in Argentina where you're paid in Argentine pesos that lose 10% of their value every month. And your practice when you get paid is to immediately exchange your pesos for physical dollar bills at the local foreign exchange shop. Now, what if you could simply cash your peso check, your peso paycheck, with a vendor who then buys dollars and sends those dollars to your stablecoin account? Now, the banks have no control over it, so they could not charge a fee or cheat you on the official exchange rate. I should say on the market exchange rate. Your holdings of USDC tokens are easily accessible with your phone. The assets backing these tokens are supported by T-bills, which in turn are backed by the full faith and credit of the U.S. government. Your ownership of these tokens is protected by the distributed ledger cryptography, which to my knowledge is nearly impossible to hack. And as long as you trust the stablecoin, this is a much safer and more convenient thing than hiding American dollars in your house. I can think of many other examples where stablecoins could be appealing to those who are unbanked or under political stress. In other words, instead of carrying around a suitcase filled with $100 bills, people in areas not well served by banks or without access to U.S. dollars only need a phone and a stablecoin account to transfer dollars or dollar equivalents to anyone else with a phone and an account. And I would say that is genius indeed. So Scott Besant is probably right to be enthusiastic. Here are two charts from a 2024 study by the Bank of International Settlements. This is a report that Besant has no doubt read. The chart on the left shows that in 2024, stablecoins were relatively small holders of treasuries compared to sovereign governments and money market funds. But as the chart on the right indicates, annual purchases in 2024 We're just behind money market funds and just behind China, indicating a very rapid recent growth. According to this BIS study, an additional advantage for our Treasury Department is that the high demand for stablecoins could lead to lower T-bill yields, which would in turn decrease the government's interest expenses. You may have noticed the recent pressure from the Trump administration on Jay Powell to lower short-term interest rates, which would further reduce, the interest rate paid on T-bills. So the combination of expanding the T-bill market and a Fed move to cut short-term rates would have a very positive impact on the government's interest costs, where relief is badly needed right now. I also see the potential for bad actors to exploit some stablecoin systems. The U.S. government isn't the only entity interested in stablecoins. Just a few days ago, on June 24th, the Financial Times reported a successful transfer of $9.3 billion worth of Russian rubles. The token known as A7A5, launched in Kyrgyzstan, of all places, by a fugitive Moldovan oligarch, is pegged to the ruble, and it was created to facilitate cross-border payments that bypass U.S. financial sanctions on Russia. And now, as I mentioned, this is essentially the new way of transporting crates of $100 bills around the world. And the USA wants to avoid gaining a reputation of as a supporter of klepto coins like this, and it's hoping that its efforts to regulate stablecoins will minimize money laundering and maintain the reputation of the U.S. financial regulatory system. And this is where U.S. government regulation could help boost confidence and legitimacy in U.S. stablecoins. These stablecoins offer a new way to hold U.S. government obligations. I mean, they're accessible to the general public, including the unbanked, rather than just the large financial institutions or sovereign monetary authorities. The wider access to T-bills will improve the marketability of the U.S. dollar, thereby strengthening its dominance in areas that with currently have limited dollar access. And you can see why these so-called cryptocurrencies are often referred to as the democratization of finance. Okay, now a few more questions may arise. Are stablecoins inflationary? Well, not really, based on my understanding of inflation, because no new money is created when a citizen buys a stablecoin. However, stablecoins might influence how much cash people want to hold in their bank accounts. For example, suppose I usually keep $1,000 in my checking account as a reserve, then along comes stablecoin, and I decide to convert that $1,000 into stablecoin tokens. I give my $1,000 in bank deposits to Tether. Tether uses it to buy T-bills, meaning they send that money to the government. Now, when a bank deposit is used to buy T-bills, the money is transferred to the Treasury's general account, or the TGA, which consists of cash reserves deposited directly with the Fed. So sending bank money to the Treasury reduces both bank deposits and bank reserves, while the Treasury's account at the Fed increases. However, the Fed doesn't count the Treasury's money, the TGA, as part of the money supply. So technically, the way the Fed counts it, the money supply decreases. So you might think on that basis, this is deflationary. But as I wrote in Appendix 1 of Black Hole, I believe this is mistaken accounting, because in my view, the government's money, whether it's held at the Fed or in the TGA or in a commercial bank account, and by the way, the U.S. government used to hold its money in commercial bank accounts before the great financial crisis. So whether the money is held in a bank or in an account at the Fed, it's still like other money and should be included in the money supply because it's going to be spent very soon. And by the way, many Austrian economists agree with me on this point, that the TGA should be included in the money supply. So ultimately, I believe a correct definition and understanding of the money supply tells us that stablecoins will neither create nor destroy money and are therefore not inflationary, although they may cause some shifts in demand that some prices, cause some prices to rise and some to fall. Okay, another interesting question. Some analysts say a wider adoption of stablecoins will boost the entire crypto market, and drive up the price of Bitcoin. That's an interesting supposition. However, I'm not so sure about that. I don't see why that should happen. As Scott Bessent explains, the use of stablecoins might strengthen the dollar by increasing demand for T-bills, but I don't see why it would also increase demand for Bitcoin, which isn't backed by treasuries or anything else for that matter. So we'll have to wait and see on that question. If there's a connection there, I don't see it. Now, finally, are stablecoins money? Now, I do not consider them to be money because they are not yet a commonly accepted meaning of exchange. That is von Mises' definition and my definition of money. They're not insured by the FDIC, although the FDIC is going to be their major regulator, their primary regulator. Stablecoins essentially function as an accounting system, a database designed to transfer claims on T-bills and other high-quality assets from one token owner to another. As long as T-bills remain easily convertible into dollars, these stablecoin instruments can be valued at $1 per unit, similar to a money market fund. But if for any reason T-bills were to significantly decrease in value on the open market, which does seem unlikely at this point, these instruments could no longer be trusted to maintain their $1 per token value. So I would call stablecoins a derivative of money, but not actual money. Okay, let's wrap things up. Thank you for staying with me for so long. Stablecoin technology is really fascinating, and it has major implications for the T-bill market. And I want to mention it's also being used at Monetary Metals and Company, where I sit on the board, which has initiated a project to tokenize gold ownership. Unlike other gold tokenization projects, which have not really been very popular, Monetary Metals hopes to boost the appeal of the gold stablecoin by improving on previous tokens. In other words, by paying interest on that gold token in gold. So for more information on that project, I've included a link in the attached PDF and the Substack text for your reference. Thanks for listening, and see you next time.